The bond market is screaming a rare warning, but is anyone listening? Imagine this. The Fed starts to cut interest rates to save the economy, but long-term bond yields defy logic and go higher instead. This bizarre bear steepener has only happened one other time since the 1950s. Back in 1980 under Paul Volcker, what followed? A brutal two-year recession, skyrocketing unemployment to nearly 11%, and the deepest downturn in post-World War II history. Today, the Treasury market is screaming the same warning to Jerome, Powell, and the Fed. Inflation is not beaten, and easing too soon could ignite chaos, but are they listening? So I've mentioned this bear steepener many, many times. Here's an entire video on why what is happening today in the U.S. bond market is so unusual and so worrisome. We're going to look at cutting cycles. Remember, when we talk about the Fed and the interest rate, what we are referring to is what's known as the federal funds rate. This is the cost of an overnight dollar loan. Now, most people do not participate in this, but the banks surely do. There are trillions of dollars in these overnight SOFR markets, these overnight very, very short-term dollar loan markets. We've done entire videos that go way in depth of how they actually work, how the Fed actually sets the federal funds rate. I will link that at the end of the video. But remember, that is what the Fed rate is. It is the cost of an overnight dollar loan, and that is represented here in white. Now, remember, the yield curve is a curve. There are many different durations of U.S. Treasuries, starting at the very, very short end, which is, say, the federal funds rate, overnight dollar, all the way out to a 30-year dollar loan, 30-year Treasury yield. Back here in the 1950s, we didn't have 30 years. We just had 3, 10. We had fewer options, but we are going to look at every rate cutting cycle and how the different maturities, how the different durations responded. So generally speaking, the Fed can directly control this overnight federal funds rate. Generally speaking, they have pretty much direct control over a 1 month or a 3 month or 6 week Treasury. Generally speaking, as you can see, they track each other. Even really arguably the 1 year and even the 2 year really operate based on what is the Fed doing and what is the Fed likely to do in the next 3 months, 6 months, 1 year, 2 years. But then further out the curve, the 10-year, the 20-year, the 30-year, those do not operate based on what the Fed is doing. Those operate on inflation, on growth expectations, nominal growth expectations. They operate on fiscal concerns, right? Fiscal deficits and those sorts of things. Risk as well gets more priced into the long end of the yield curve. So here we're going to look at some cutting cycles. But generally speaking, the Fed is cutting that overnight interest rate. Generally in a recession, they are reducing the cost of capital. Remember, we live in a debt-based monetary system. So debt is money and money is debt. By cutting that overnight interest rate, they are encouraging lending, encouraging borrowing, encouraging investment and economic activity. Hopefully jumpstart the U.S. economy, starts to come out of it. We get higher inflation, and then they have to go the other way and start raising rates to make sure that inflation does not get out of control. This is generally how the Fed operates in a nutshell. Down here in pink, we are looking at a spread, the 10-year yield minus the federal funds rate. Generally speaking, you expect to get more yield, more compensation for buying a long duration Treasury than you do a short duration one, like especially an overnight dollar loan. However, this can steepen in two different ways. So what we are seeing here is the gap. The other way to think about the pink line is the gap between the blue line and the white line. That is just what this is representing. This gap can grow wider. This is called a steepening of the yield curve. You went from only getting 0.3% extra for a 10-year Treasury all the way up to 2.4% extra yield for buying a long duration than a short duration. So this steepness can occur two different ways. Remember, the value of the bond is inverse to the yield. So here we'll look at bond values. This is just the inverse of the yield. Here we can see that when the Fed was cutting rates, the value of all Treasuries, 10-year and the 3-month, both of them were going up. The bond itself was going up in value. Therefore, the rate was coming down. But the short duration one was moving the most. This is called a bull steepener, and it is because it is bullish for bonds. As you can see, bonds typically rally during a Fed rate cutting cycle. This is known as a bull steepener. Well, what we are seeing today is the exact opposite, and it is, as we will see shortly, really the only time that it has happened given the economic conditions that we currently have. There is one kind of slight parallel that we could draw to 1980. There's a number of notable differences. We'll look at it nonetheless, but that is what we're going to examine here is prior rate cutting cycles going all the way back to the 1950s and how the various bond yields behaved. So here again, another rate cutting cycle. We can see the federal funds rate was being cut. The bond, the yield curve steepened, but it was because short-term rates were falling the fastest. All interest rates across the curve, 10-year and the 3-month, all of them were falling. It's just the short duration treasuries were falling the most, a bull steepener. Here again, we're looking at another cutting cycle. In the 1960s, federal funds rate comes down, the yield curve steepens, you get more and more compensation, more and more yield for a 10-year, and it is because all rates are coming down. It is just that the short duration rates are coming down the most. Another cutting cycle here into 1971, and we can see the same thing. Fed cuts overnight interest rate, yield curve steepens, and it is a bull steepener because the value of the bond is going up, or put another way, the yield is coming down. Remember, the value of the bond is inverse to the yield. Very important concept as we talk about what is bullish for bonds or bearish for bonds. Here's another cutting cycle in 1974. Again, Fed funds rate is coming down. The yield curve is steepening, and it is doing so in a bull steepener. The 10-year Treasury went from about 8% down to about 6.9%. Steepening of the yield curve, as we can see here in pink. Here's another rate cutting cycle. Fed is cutting the overnight interest rate. The spread here between the 10-year and the federal funds went from being deeply inverted, which is not normal. This is where you get actually more interest on the shorter duration treasuries than you do on the long duration. This is called an inverted yield curve. This is very abnormal. We went from a deeply inverted yield curve to a positive sloping yield curve, barely, ever so slightly, but the yield curve did steepen nonetheless. The gap became less negative than it was here, for example. But rates were coming down. They were just coming down the fastest in the short duration bonds. Here again, another cutting cycle. This is kind of a one big long cutting cycle you can think of. And again, the same dynamic is true. Federal funds rate was coming down. Yield curve was steepening. It is just that the short duration bond yields were coming down the most. You could split this up, and if you want to pause the video and look at each, theoretically, you could look at a couple, you could split this up. It is true, not even if you split it up into kind of smaller rate cutting cycles, the same general trend is true, which is the federal funds rate was coming down. All bond yields declined. It's just that the short-term bond yields declined the most. So if you want to pause and look at that, it is true throughout the 1980s. Here again, in the early 1990s, we can see the federal funds rate was being cut. This was after long-term capital management and the recession. The federal funds rate was coming down. Bond yields across the curve declined. They just declined the most here at the short end. Remember, the pink line is representing the difference between the gap between the white line and the blue line, which is the 10-year Treasury yield. Now we are starting to get the 30-year data. This started to be issued, so we can start including that as well. Here's another rate cutting cycle in the late 90s. And again, bond yields came down across the curve as the Fed was cutting rates. They just came down the most at, say, the 3-month. Here again, following .com, another bull steepener. Rates were coming down. They were just coming down the most at the short end, and therefore the spread widened, and therefore the yield curve steepened. But remember, it did it in a bullish way. The value of the bond was going up. Therefore, the yield was coming down. It was just more sharp at the short end of the yield curve. Again, this is going to cause the gap to widen between the blue line and the white line and cause the yield curve to steepen down here, the spread to increase. But again, it matters how it is happening. Are yields coming down and the gap is growing wider, or are yields going up and the gap is getting wider, which is what we'll look at in a second. Here's another rate cutting cycle after the GFC. Again, federal funds rate came straight down, and bond yields across the curve came down. They just came down the fastest at the short end of the yield curve. Therefore, the yield curve steepened, the spread widened for a 10-year Treasury yield versus that overnight dollar interest rate. And then here again, in 2019, 2020, we can see the Fed cut the overnight interest rate. Rates across the curve came down just most sharply at the short end. Or the yield curve steepened, the spread widened. You got more and more yield on a 10-year than you did at a short duration. Well, here's the current rate cutting cycle that we are in. It started back right before the last election, September 2024, and look at what has happened. Interest rates have actually gone up. So this is not generally what happens. And remember, the interest rate is inverse to the value of the bond. So put another way, the value of the bonds has actually gone down. This is why it's called a bear steepener. It is bearish for bonds. Here we can see that the Fed has cut the federal funds rate from 5.3 all the way down to 4.3, and the 30-year Treasury, so that's 100 basis points of Fed cuts, and the 30-year Treasury yield has gone from 390 to 490. So it has gone up by 100 basis points. Here we can see that, again, if you were just looking at the pink line, you wouldn't really know anything notable is going on, right? The yield curve is steepening. The spread between the 10-year and the federal funds rate is increasing. It is going positive, is a positive sloping yield curve. It is a steepening yield curve. But this alone does not tell you all the data. You have to look at, are rates going up and the gap is growing wider, or are rates going down and the gap is growing wider? Now, a bear steepener is very, very, very unusual. It's really only happened one other time. If you were forced to draw a comparison and find one other time that this happened, you would have to look to 1980 under the kind of Paul Volcker following the great inflation, where they had double-digit inflation and there were all sorts of issues in the energy markets, right? Back in the 70s, stagflation. So that's what we're going to look at here. We can see the federal funds rate here in 1980, December 1980, was 19%. During this period of time, inflation, which is what we're looking at in red, was running at 12%. Now, what is important here, what I think is an interesting parallel, inflation had peaked back in April of 1980. So it was coming down when the Fed started to cut interest rates. Inflation had been coming down. They had what's known as disinflation, meaning costs are still going up, prices are still going up. They're just going up at a slower rate than they used to. This is called disinflation. So they had been having disinflation from April of 1980 all the way through to December of 1980 when the Fed decided to start cutting interest rates. Well, look at what bond yields did. The 10-year Treasury yield went up, and so did the 1-year. Now, it's not normal for even the short duration. Remember, those short duration treasuries are much more responsive to what the Fed is doing or what the Fed is likely to do over the next 1 year. Even the short-term rates went up as the Fed cut the federal funds rate from 19% down to about 14%. So despite Fed rate cuts, the 10-year Treasury yield went up, the 1-year Treasury yield went up, and to some degree, even the 3-month Treasury yield went up. So this is what's known as a bear steepener. Again, because remember, what was happening during that time period is the value of bonds was going down. As the Fed was cutting interest rates, which normally should cause a bid into bonds, you had the value of the bonds going down, therefore the yield was going up. This was a signal by the bond market that, hey, Fed, hey, Paul Volcker, you are not treating this seriously enough. We are very worried about inflation. Because remember, the reason what a 10-year Treasury is trading off of is inflation and growth and fiscal concerns. That is really what the 10-year is trading off of. If they believe, if you just live through, 14% inflation, that would have smoked bonds. Therefore, bond investors would be very scarred, very traumatized from that very, very high inflation. They would see any kind of concern, any lack of seriousness about inflation, they would be immediately jumping on it and demanding a higher interest rate because, again, they got smoked during the 70s into the early 1980s. They got smoked. Inflation ran way higher than the interest rate on their bonds. They lost a ton of money. They were traumatized. Therefore, they were very worried about inflation, and therefore they saw the Fed cutting the interest rate from 19% down to 14%. They thought that was not necessary, or it was not taking inflation seriously enough, and that it would cause further inflation. It would cause this disinflationary trend, the red line going down. They, thought maybe this is going to start to break out and go higher again, right? So they demanded a higher interest rate, higher yield to compensate for that risk. Now, there were two other factors that were going on during this period of time. Ultimately, what happened, though, however, the Fed did eventually reverse their cutting, the course that they were on of cutting. They reversed course and took the federal funds rate from 14.8% back up to 19%. We can see what eventually happened. This is a 2-year-long recession, and we will look at a second how that affected things like unemployment and growth. Here is the federal funds rate in white minus CPI. So this is the white line is telling you how far above inflation is the federal funds rate. Here at the peak, it was 9%, 9.5% higher than inflation here in June of 1981, directly before that recession started. This you can think of in some ways as a real rate. This is telling you how restrictive is that federal funds rate relative to inflation. Well, if you look today, we are only at 1.63%. So the degree of restrictiveness is so much smaller today than it was back then. Here is in green the 10-year Treasury yield minus inflation. That is a bit harder to see, but that was much more positive as well. Here in 1980, it was about 4.6% above inflation. If we look now, it's only 1.5%. So the real rates, interest rates in general, were much higher relative to inflation than they are today here at the levels that we're seeing today. The other issue that was going on, so I had mentioned there were a couple notable differences. One of them was oil. So there were a whole bunch of Middle Eastern conflicts and supply chain issues. The price of oil went from $15 a barrel all the way up to $42 a barrel here in 1980. So more than doubling. This, of course, this would be akin to oil going to, I don't know, $130 a barrel in over the next year. This has a significant effect on the cost of inputs within the broader economy, right? Everything is transported. People need to get to work. They got to put gas in their car. Oil and energy inputs go into everything. So if the price of oil makes a sharp move upward in a short amount of time, this can have a profound effect on inflation, and sure enough, it did. The other thing that was going on here is look at wage growth. So here in 1979, wage growth was running, each of these dotted pink lines represents a 3% increment over this, which is 0%. Wage growth was running at 13.5% in 1979, meaning on average, wages were going up 13.7% every single year at that rate in 1979. This created what was potentially going to be what's known as a wage price spiral. And there were concerns about this, which is part of the reason that those bond yields were moving higher, is the bond market was seeing wage growth. So if we zoom in here and look at, remember, the Fed started to cut interest rates here in 1980 going into 1981, we can see what happened with wage growth. Wage growth bottomed here in July of 1980, and it was heading higher. And this was a major concern at the time, that wage growth went from 8.4% here in July of 1980 all the way up to 11.3%. So wage growth actually started to reaccelerate despite the fact that inflation was falling. And again, the price of oil had spiked. There were geopolitical tensions in the Middle East and all sorts of concerns over the oil market. But this was also important as well. This could create a wage price spiral where prices are going up. Therefore, average Americans demand higher wages. Well, they get the higher wages, so now they have more money to spend in the real economy on a scarce amount of goods and services, pushing the price of those goods and services up. Therefore, right, and it becomes a spiral, that self-perpetuating cycle, self-reinforcing cycle. This was one of the major concerns at the time, is that wage growth, despite inflation falling from 14.5% down to, say, 9%, despite this disinflationary trend, you had wage growth starting to pick up again. This is really important. This is an important parallel to where we are today. Now, the other thing I'll point out, here's unemployment rate. When Paul Volcker ended up taking the rate back to 19% after the bond market revolted, it created one of the sharpest recessions going back to World War II. So unemployment reached about 11%. And here I'm putting my cursor over the peak. You can see this is very, very high relative to any other time going back to 1950. The past 75 years, unemployment has only reached 11% one other time, and it was during 2020. Here is real GDP, real inflation adjusted growth for the aggregate of the US economy, gross domestic product. And again, what I want to point out is the period of time, the downtrend. This is the kind of entire silent depression thing. We've done other videos on that. But you did break above briefly. This really put a severe constraint on the US economy. Now, there were a number of notable differences back then where raising interest rates was a much more effective tool at constraining economic output. Private bank credit creation, remember private banks print money. They are the prime printers of money. They print about 85, 90% of the dollars in the current US economy. They were the prime drivers of credit creation. Well, now, post 2008, that is not true. You can look at the last video we did yesterday that illustrates that really well, I think. So there's a number of notable differences. If private banks are creating most of the money, well, raising in the interest rate has a much more constraint like effect on that private bank credit creation. Therefore, less dollars are being printed by the private banks. Therefore, you get constrained economic activity. Well, if we look now, who is printing the vast majority of our money? It is the federal government with M0. So here we're looking at M2 money supply, which, by the way, just broke out to a new all-time high. The money supply just broke out to a new all-time high. The other notable difference here is that debt to GDP was much lower. So here in 1980, debt to GDP, this is a critical difference, was only 32% debt to GDP. It is now 124%. So it is now 4x higher than it was back then. So the implications here are a lot different with 32% debt to GDP versus 125%. Of course, the other issue at the time and why bond yields were going up, which is an interesting parallel to where we are now, part of the reason that we saw this bear steepening here in that kind of period of time was because of a debt issuance and supply of debt. So if we go back to 1980, here we can see that the deficit was running at about 2.5, 3% of GDP. If we look today, it is double that, right? And what this means, remember, the way that we cover the fiscal deficit or the gap between spending and revenue, the way they cover that is by issuing that amount of debt. We get dollars, or the Treasury gets dollars, can then spend them on whatever the government wants. And that is how we finance the deficit, is by issuing that amount of debt. And back then, there were concerns over a 2% deficit. Well, we are running at 6, arguably it's 7% currently. 7% of GDP is our current fiscal deficit. So what that means, every year, we must issue 7% of our total GDP in new debt in order to finance the government. That is what that means. And so what that means is there's more bonds being issued. The supply of bonds is going to be increasing. And sure enough, the deficit did get worse in that sharp recession of 1981 into 82. The deficit got as bad as 5% of GDP, which is normally what happens, by the way. The deficit normally widens during a recession. This is part of the reason we can't afford a recession, is it would take our deficit to 15% of GDP. But that's a whole other video that I will also link at the end. But the point here is that bond supply, with a large deficit, the supply of bonds is going up, right? The Treasury is issuing more and more bonds. Well, if there's only so much demand, what that means is the price must go down. Put another way, the yield must go up. So the bond market was worried about wage growth reaccelerating. They were worried about bond supply due to the deficits, and ultimately caused the Fed to reverse course and take that federal funds interest rate back to 19%. Well, if we look at what is going on today, now again, this is just objectively true. It is not a statement on the whether this is a good or a bad thing. But if we look at what is going on today, wage growth has been falling going back to 2020. Inflation has been falling since 2022. But what the Trump administration is doing is they, just as for many decades, both parties increased the labor supply to keep wages constrained, to keep wage growth low, to keep inflation low, just as both parties had done that for the past 4 or 5 decades. What Trump is doing is the opposite, which is he is reducing the labor supply. Well, what that means mechanically, if the demand for labor stays constant, what that means mechanically is wages must go up. So just as increasing the labor supply with foreign labor, over the past 50 years, just as that kept wage growth low, if you do the opposite, which is what Trump is doing now, that mechanically will push wages higher. So again, the other thing that is really critical is not only wage growth, but kind of the inflation expectations. What Jerome Powell calls a de-anchoring of inflation expectations. This is where Americans, the average everyday consumer, gets so scarred by inflation that they start envisioning the future having much higher inflation. Well, if you look at inflation expectations by the University of Michigan, they are running at 5.5%. Now, Jerome Powell actually mentioned a wage price spiral in the Jackson Hole speech on Friday. He said he sees no indication of that because I don't know what data he's looking at, but he sees inflation expectations moderate, constrained, relatively reasonable. Again, I don't know what data he's looking at because University of Michigan has the 1-year inflation expectation at 5.5%. We can see wage growth is running at 4.8%. So again, this is highly dependent on wages. It is highly dependent also, therefore, a kind of second derivative of that is what are average Americans expecting for inflation? Because if they are expecting higher inflation, like for example, 5.5, 6% inflation over the next 1 year, they are going to demand higher and higher wages. Well, as they get those higher and higher wages, remember the labor supply is decreasing due to immigration policy, so they will get those higher wages. What that means is that now there's more dollars to spend on goods and services, pushing the prices up. People see prices going up, they demand, the trauma of the past 5 years comes to bite, and they're like, oh no, not again. So they start immediately going to demand higher wages, and you get into a wage price spiral. So the parallel with wage growth, now we don't see what we did back then, which is wage growth actually breaking out and starting to reverse and go up again. We do not really see that. Wage growth has been falling. I mean, month to month, you get these little pops where you think, oh, maybe it's breaking out and reversing the trend and about to start going higher again. You kind of get those month to month, but we haven't really seen a significant a trend change yet in wage growth. But the immigration policy of this current administration is, if they continue, is likely to push wage growth higher. Now, this is the only way that this will not happen is if AI is able to, come in and reduce the demand for labor by an offsetting amount. That the administration is reducing the labor supply. If they both, if you reduce the supply and demand equally, then you will not mechanically see higher wages. But if they are able to decrease the labor supply by more than the demand is being reduced, you will mechanically see higher wages. And again, people are very scarred by the past 5 years, and I think are very eager to go in and demand higher wages. Now, the final point here is, unlike the 1980s, where the price of oil, which again, critical input for inflation, more than doubled here in 1980, and there were significant geopolitical tensions and a bunch of supply chain issues back then. Here now we see the price of oil falling. So this is a positive. But regardless, the bond market is screaming a warning that it appears the Fed is not really listening to, because on Friday, Jerome Powell indicated, in my opinion, it was quite dovish of a speech that he gave on Friday, and said basically we're prepared to cut even in September. Core CPI is running at 3.1%. You are in the middle of a bear steepener where 30-year rates have gone up by 100 basis points, despite you, Jerome Powell, cutting by 100 basis points. The bond market is screaming a warning here, just as it did back in the 1980s. And, the difference is, if Jerome Powell does not listen to the bond market, which is, again, tens of trillions of dollars of capital, if he does not listen to the bond market and does not reverse course, then, we could expect significantly higher inflation. Now, there is the possibility that he, finds the error in his ways, listens to the bond market, reverses course, raises rates again, and causes a severe recession. But I don't think that that's very likely, given all the political drama. Right, his term is expiring within 6, 7, 8 months, so his term is expiring. You already have high tensions between Trump and Powell. Imagine if he started hiking interest rates. Trump would surely fire him. So I think we are in a much different time period. But the bear steepener, there's always a release valve. So here they took rates higher again, constrained the overheated economy, ended up causing a recession. Well, if they don't hike rates, which I don't think we're going to see this sort of taking the federal funds rate higher. If they don't do this, that's okay. It just means the release valve is a much weaker currency. There's always a release valve. They don't have to take interest rates higher. But there is always a consequence. There is always a trade-off, and it is a weaker dollar. It is less purchasing power. It is higher inflation, fiscal dominance, and on and on. So, anyways, hopefully that was helpful. Hopefully that was educational, and I will catch you in the next one.